Good morning, everyone. It's great to be here with you all in this virtual environment. Thank you for spending part of your day with us, and thank you for your support of Intuit over the last year. We've gone through a lot of content this morning, so thank you for staying with us, and we're almost to Q&A. I hope you found the platform immersion experience helpful again this year for understanding how we're solving some of our customers' most important problems in the current environment as we make progress against our strategy of becoming an AI-driven expert platform. And I hope you enjoyed hearing from Laura how our strategy intersects with our principles for corporate responsibility. We added that this year in response to many of your questions. Before jumping into the numbers, I want to acknowledge what was a very dynamic fiscal 2020. This year was full of challenges for both our small business and consumer customers, but I'm proud of how resilient our platform was as we focused on helping our customers. In small business, we saw an immediate impact from shelter-in-place orders during the third quarter. And while we saw trends improve in the fourth quarter, demand remained below pre-COVID levels, yet we still delivered revenue at the high end of our 10 to 15% long-term revenue growth range. In tax, we faced an unprecedented delay in the IRS filing date, yet we had a remarkable year. We're very pleased with the 13% revenue growth we delivered in the consumer group. We estimate the DIY category grew over 2 points this season. Our share of total tax returns grew over 1.5 points, and we grew customers at the fastest rate in 4 years. Additionally, the longer season gave us the opportunity to experiment as we prepare our strategy for next season. And underpinning all of this is our AI-driven expert platform and 5 big bets, which are focused on solving our customers' biggest challenges and will drive durable growth for our platform. Let me remind you how we are managing the business in this environment. First, we remain focused on keeping our employees safe and healthy. This is our number one priority, so they can continue delivering for customers. Second, we're focused on doing the right things for customers, giving them access to the tools and products they need most. Third, we're managing for the short and long term and controlling discretionary spend to deliver results while investing in what is most important for future growth. And lastly, these principles are designed to accelerate our execution and innovation in the future and help both our customers and Intuit emerge from a downturn in a stronger position than when it began. And while the year had plenty of surprises, we executed well against the objectives we outlined for you at Investor Day last year, which are on the left side of the slide. On the right, you'll see the outcomes we delivered against those objectives, even in the uncertain environment we faced. We achieved our goal of double-digit revenue growth with 13% growth at the company level. Our 2 main online platforms, QuickBooks and TurboTax, are now $4.8 billion and growing 22% combined, with small business online ecosystem revenue growth of 31% for the year. And we grew GAAP and non-GAAP operating income by 17%, driving a point of operating margin expansion, and I'll touch more on that in a minute. We also remain pleased with our ROIC and the consistent dividend increases we've been able to provide. We use our financial principles to guide the decisions we make. These should look very familiar as they remain unchanged. Each year, we challenge and discuss them during our planning process, reaffirm them as a management team, and confirm them with the board. Let me provide a little bit more color and context on each. First is double-digit organic revenue growth. We continue to see a large opportunity ahead in serving consumers, small businesses, and self-employed to grow the company's revenue double digits as we expand the set of customer problems we address through a broader set of products and services. Next, we focus on growing operating income dollars faster than revenue. It's good discipline for us to approach each year with expenses growing slower than revenue. And as we've said, we manage margins at the company level, so I wouldn't focus too much on small changes you see in the operating margin at a business unit, given the leverage we get from the technology platform that supports many of our products and services. And I'll share more on this in a minute. And while we are not driving towards a particular level of annual margin expansion, we are starting to see the leverage of our platform. Next, we deploy cash to the highest yield opportunities, targeting a 15% ROI over 5 years. This principle is key to managing our business for both the short term and the long term. Whether we're looking to expand into new products and services, or as we invest more deeply into our core technology platform, this threshold is key to making all internal investments that will deliver for years to come. And we also apply the same hurdle to any acquisitions that we're considering. After this, we return excess cash to shareholders. This speaks to our stewardship of how we handle the capital we generate and comes in the form of buybacks and dividends. On share repurchases, we utilize a smart grid to achieve a rate of return over time that exceeds our own cost of capital. While we were out of the market in the fourth quarter due to our pending Credit Karma acquisition, we do expect to be back in the market in the future. And finally, we manage to a conservative investment-grade balance sheet that can sustain our business through all types of economic cycles. This has served us well in the past and lets us lean in during downturns like we're experiencing today to emerge even stronger on the other side. Our QBO and TTO platforms are driving our revenue growth, and we expect this will remain the case going forward. In 3 years, we expect more than 70% of our revenue to come from these offerings. We'll continue to support customers using our desktop offerings as these remain very profitable, which allows us to invest in new products and services. And as we've shared before, a large amount of our revenue we expect to see in fiscal 2021 will come from existing customers, which means we have a highly predictable revenue model. Similar to what I shared last year, we expect more than 80% of our revenue this year to come from customers we already have or who are expected to return based on past behavior. Customer growth remains an important part of our strategy across both of our businesses. As Alex and Greg shared earlier, we're solving a broader set of customer pain points across a larger customer base in each of our businesses. Starting with QBO, on the left side here, you'll see total paying customers. This includes QuickBooks Online, our desktop subscribers, and desktop unit sales. Once again, our total net adds grew in fiscal 2020, despite COVID-related headwinds. Our desktop base remains relatively sticky, but we continue to see the majority of customers who are new to QuickBooks choosing QBO. We still have a large runway ahead in the US as well as internationally, with a broader set of customers from the self-employed to the small business mid-market. And as Alex shared earlier, we're opening up new opportunities for growth and revenue by broadening who we serve, how we serve them, and what we serve them with. This includes virtual expertise, the mid-market, and omni-channel customers. We're also delivering more value across our products, which improves our monetization over time. And this resulted in 56% customer growth in our top ARPC bucket in fiscal 2020. Moving to the consumer group, we continue to see traction with our goal of growing our share of total tax returns. This year was highly unusual with the delayed IRS filing deadline. We were pleased to help drive growth in DIY category share of over 2 points, the fastest in 15 years. And we increased our share of total returns by over 1.5 points. As we focus on transforming assisted, TurboTax Live opens up the $20 billion assisted segment of the tax prep market. Our TurboTax Live customers grew nearly 70% this season, and this offering was again a meaningful revenue contributor, but we continue to see plenty of runway ahead. We also grew the base of customers paying us nothing, just over 20%. Bringing customers onto our platform via our free offering remains a key element of our long-term strategy as we seek to solve a broader set of customers' financial needs and disrupt consumer finance with Turbo, Mint, and upon closing, Credit Karma. Lastly, when free customers are removed, you'll see that our average revenue per return has seen very healthy growth for a number of years. Everything we do is customer back, and across all of our businesses, we're able to improve monetization as we increase the value we're providing to our customers. ARPC is not something that we manage to, it's the output of the various decisions we make regarding customer and revenue growth. But that being said, we recognize that it's a key input for many of your models. So looking at QBO worldwide, we saw an increase in our ARPC this year across our US, international, and self-employed businesses. We're increasingly focused on growing higher value customers, and we're seeing traction with this strategy as we expand into virtual expertise, the mid-market, and omni-channel. We continue adding value across all of our products, which improves monetization opportunities over time. Going forward, we expect QBO worldwide ARPC to continue increasing. In the US, this will be driven by our maturing customer base and increased monetization via online services and higher value products like QB Live and QBO Advanced. Outside of the US, we expect to see an increase in ARPC from our maturing base and lower promotional activity. Turning to QuickBooks Desktop, we see an increase in ARPC due to strong growth in our mid-market desktop enterprise solution, which we expect to continue. And in consumer tax, we saw another year of ARPC increases due to the contribution by TurboTax Live and some minor price increases. And this was offset by strong growth again in free this season. Durable revenue growth and disciplined investment have driven our operating income growth historically, and we remain focused on both going forward. We expanded operating margin by 1 point this year as we followed our playbook for operating in a downturn, while we also began reaping the benefit of a platform approach. On this slide, you'll see our long-term expectations for the P&L, and this looks a bit different than it has in the past, as we've evolved how we manage our cost base as we become an AI-driven expert platform. Gross margin has been relatively stable in the low to mid 80% range, and we expect that to continue. While we look at each of these lines individually during our planning process, we expect each to be flat to down as a percentage of revenue over time, as our platform evolution enables new drivers of operating margin expansion. Sales and marketing is an important area of focus as we grow our businesses and build our brands. LTV to CAC targets provide the guardrails for our investment in small business, while the consumer team focuses on a 1-year payback in our tax business. As for R&D, we expect to invest more effectively and efficiently as we leverage key services and capabilities across our businesses to accelerate innovation, which is our ultimate compass. And we continue to see an opportunity in G&A to generate some leverage as we grow, and we're working hard to make sure we're best in class. A key element of our financial principles is to grow operating income dollars faster than revenue, resulting in some margin expansion each year. However, as we lean into our platform strategy, we're starting to see the opportunity for faster margin expansion than we have in the past few years as we leverage key services and capabilities across our businesses. We're increasing the velocity of development on the platform to deliver even faster benefits for customers across all of our products and services. This includes our AI capabilities, our expert services, money movement, and fraud and risk capabilities. We're scaling our customer success platform across our products and services to more effectively and efficiently serve our customers. And our go-to-market capabilities leverage a common infrastructure to effectively target and manage the sales and marketing process efficiently. Our platform evolution in each of these areas creates opportunity for faster margin expansion over time. At a high level, our approach to investment hasn't changed. We invest in the highest yielding opportunities with a focus on investing to drive durable growth and accelerating speed and velocity, all within the context of our financial principles. Making deliberate trade-offs to allocate investment to the best opportunities remains a core element of our DNA. We continue to prioritize investments in our big bets, including connecting people to experts, unlocking smart money decisions, being the center of small business growth, and disrupting the small business mid-market. And underpinning all of this is the focus on revolutionizing speed to benefit through the technology platform I shared earlier. We'll be allocating more of our investment dollars into these areas to drive durable growth over the long term, while being very deliberate about investments in core innovation and running the business. It's important to us to be effective stewards of capital, especially in the current environment. This includes investments in organic growth drivers, as well as acquisitions to accelerate progress against our strategy, whether it be in talent and technology or to help fill out our product roadmap. Over the last 5 years, we've returned over $6 billion to our shareholders through share repurchases and dividends. We repurchased nearly $320 million in shares during fiscal 2020, and I'll touch more on repurchases in a minute, as this remains an important tool to return capital that can't be invested profitably in the business. Though we temporarily suspended share repurchases in conjunction with the Credit Karma acquisition, we expect to be back in the market in the future. As for dividends, our board declared an 11% increase in the dividend for fiscal 2021. and we continue to expect our CapEx to remain at approximately 2 to 3% of revenue. Our philosophy and principles on share repurchase remain consistent with what we've shared in the past. That being said, let me quickly remind you how we manage our program. We limit repurchases to cash that can't be profitably invested in the business or used to make prudent acquisitions. We apply rigor to the process by utilizing a smart grid to drive various levels of repurchases at each price range with a goal to exceed our cost of capital on average. At a minimum, we expect to offset dilution over a 3-year period. However, we don't expect to be compliant with this principle in the short term following the Credit Karma acquisition. Looking ahead to this year, we are not providing guidance, reflecting the uncertainty in the macro small business trends. In the consumer group, we're confident in our plan and strategy next season, though we acknowledge that we face a challenging comparison after the acceleration we saw in our results this season. We've grown consumer group revenue double digits 3 years in a row, and we continue to expect growth in the range of 8 to 12% each year. We believe the current environment is accelerating the trend towards virtual solutions, and TurboTax Live is well positioned to help customers in this environment. We don't see anything that would lead us to believe we'll be outside of our longer-term range this year. In small business and self-employed, we see several scenarios for how the economic recovery may impact our performance this year. These are consistent with what we shared on our fourth quarter earnings call, so I won't review them again here in detail. But these are the scenarios we're considering as we run the business in this environment. Though we're not providing guidance for fiscal 2021 at this time, don't confuse a lack of guidance with a lack of confidence in our strategy and big bets. In fact, we have more confidence than ever in our ability to drive long-term growth across our platform, given our accelerated innovation across the company. I want to quickly highlight something we shared in our 10K, which is that Intuit could incur arbitration fees of approximately $120 million beginning in fiscal 2021. I want to give you a little bit more context on this item. Intuit is the target of a law firm whose standard approach seems to involve making a demand that companies pay a settlement amount to the law firm instead of paying fees associated with arbitration. An increasing number of companies are facing similar attacks by the same law firm. There were approximately 42,000 arbitration claims pending against Intuit at the end of fiscal 2020. We're in the process of disputing these fees, and we believe this is an abuse of the arbitration system. One other housekeeping item. Going forward, we're changing the name of our strategic partner group to the ProConnect Group beginning in fiscal 2021. This better aligns the name of this reporting unit with the segment that is driving revenue. So in summary, we had a dynamic fiscal 2020. We're set up to continue our strong performance for fiscal 2021 and beyond. Our AI-driven expert platform unlocks opportunities to better serve customers across our businesses as we focus on offering them the products and services that solve their biggest problems. And as our investments on this platform can be used across all of our offerings, we see new opportunities of operating margin expansion in the years ahead. I look forward to connecting with all of you throughout the year and keeping you apprised on our progress. Thank you.